Okay, thank you everybody for joining us. My name's Robert Beatty. I'm with C.O.R.E Group. Um, Today is the fourth in our series of presentations in the fourth quarter. Thank you for taking time out of your day to join us. Long-term care is, I believe it's one of the most underserviced solutions for clients from a financial advisory perspective. And we'll get into some of the details as to why I say that. But for the average person, and I'm talking people in the semi-affluent to the affluent marketplace, it is most likely the single largest uninsured financial risk that they will face after the age of 65. And again, we'll get into the reasons why I say that. But to put it in perspective, less than 10% of the US population has some type of a private long-term care solution in place. It's a big marketplace, but I also think it's, from an advisory perspective, it is a risk that needs to be talked about a lot. It needs to be spelled out for our clients, solutions presented so that clients can make informed decisions about whether they want to insure or self-fund the solution. And that's a distinction too. We've got some interesting pieces. The concept of self-insuring is really a fallacy. It's self-funding. But anyways, we're going to focus in on long-term care and long-term care solutions. I think where we need to start is, what is long-term care? Where can I get long-term care services? Protecting relationships. This is probably, though it's intangible and hard to put numbers to, protecting relationships is the intangible part of this planning and what it can do for families, preserving relationships. And then we're going to talk about costs. Who pays for long-term care costs? We talk about favorable tax treatments. This is such a looming issue. We have huge unfunded liabilities with Social Security and Medicare and Medicaid. The unfunded long-term care issue is probably as big as the unfunded Medicare issue. And we'll talk more about that. And then things to consider as far as solutions. What are the solutions in the current marketplace? And then helping have a discussion with your clients to help them determine what's best for them and what's best for you and your clients in providing those solutions. So what is long-term care? It's a chronic illness event that requires that you are unable to perform 2 of the 6 activities of daily living without substantial assistance. And the condition is expected to last for more than 100 days. The 100 days is a magic mark because that's where Medicare stops paying. This can occur from accidents, medical conditions, aging, sickness, and cognitive impairment. The activities of daily living are eating, continence, transferring, toileting, bathing, and dressing. Those are defined in the Internal Revenue Code as far as care perspective, as well as generally speaking in the long-term care industry. These are the accepted activities of daily living. And to qualify for long-term care on most policies, you need help with 2 of the 6. Although cognitive impairment in and of itself, with no other ADL issues, is also a triggering event. So where can you get long-term care services? Long-term care is the extra personal assistance you may need to stay safe and maintain your quality of life. You can get it in your home. You can get it in assisted living communities, adult daycare facilities, nursing homes, and hospice care. So, what are the risks? And to put it in perspective, the odds of someone having their house burned down in their lifetime is 1 in 385. The odds of being in a car accident in any given year is 1 out of 63. The odds of an extended care event in your lifetime is 1 in 2. So I don't know of anyone personally that is self-insuring their house or self-funding in the event that something should happen to their house, that they're going to pay for all the costs out of pocket. And it's illegal in almost every state to not have car insurance. And yet we have something that is at least similar to a scale of losing your home from an economic perspective. And it's got a 50% chance of happening in your lifetime. And less than 10% of the population has done anything to insure against that risk. So what is the impact for caregiving? So protecting relationships. 64% of caregivers have depression. 70% report missing work because of caregiving. 59% of caregivers have at least one chronic physical condition. Why? Because typically the first caregiver is the spouse, and the spouse is of similar age. And as we age, many of us develop some type of a chronic physical condition. The average lost income for a 50-year-old woman who gives up her career for caregiving is $324,000. The average annual caregiver out-of-pocket expense is $7,242. What does that mean? From personal experiences, when you're running errands for the person and you're going out and you're buying groceries, or you're picking up their prescriptions, or you're taking care of something in their house from we need a handyman job done, and you just pay out of pocket, right? You don't go back and say, okay, you don't need this money, and you end up paying quite a bit out of pocket. And 87% of people surveyed say long-term care costs would be a significant financial strain. Why is that? We'll get into what the various long-term care costs are on an annual basis. But from personal experience, my mom was in a memory care unit for 2 years, and the cost of just the facility alone over that 2 years was in excess of $240,000. Just for her to be in a safe facility. That didn't include any of the other stuff, the dental care, all the other ancillary things that we did to keep my mother comfortable. So this protecting relationships, it's the time away from their life. If your children are taking care of you, it's times away from your life and your children and their children. It's fitting it into their schedule because they're probably working full time, and then they get off work and then they go and help and do caregiving things for their parents or for whomever they're taking care of for their spouse. It can be a significant drain. Again, 64% of caregivers have some form of depression. So economic long-term care, it's about taking care of the people you care about. By doing this planning, you're alleviating a lot of these issues for the people you care about if you're the one that needs long-term care. What are the financial costs? 50% of all long-term care services are provided in the home. In 2025, the average cost, the annual cost is around $67,787. That's the nationwide average, and that's based upon caregivers being in the home 6 hours a day, 365 days out of the year. 6 hours. That's not 24-hour care would be quadruple. It would be close to $300,000. At a 5% inflation rate by 2035, it's going to be $110,000 a year just for someone to be able to stay in their home and get care 6 hours out of the day. Community and assisted living, strangely enough, assisted living in a facility is right on par, but it's 24/7. You're in the facility. There's people on hand at all times. If you fall, there's someone there that's going to check in on you and every few hours. You've got meal prep. You got all the things you need to continue to have a good quality of life. Again, in 10 years at 5% inflation, it's $107,000 a year. Skilled nursing facilities in a semi-private room is $127,000 a year. It will be over $200,000 a year in the next decade, assuming 5% inflation. Total length of cost. So the average long-term care it combined is about, typically 1 year home care, 2.5 years in assisted living, and 1.5 years in skilled nursing. Total costs over that time frame would be about $425,000 a year. Now let's take a look at that. Let's say you have a client and you're managing $4 million of their portfolio. And your goal is, they're moderate investors. So you've got a 60-40 portfolio and your target rate of return gross is 8%, and you're charging a 1% fee, they're netting 7, and they start drawing down 10% of the portfolio every year. What does that do to the portfolio? It puts it in a downward unsustainable spiral. And again, that's if one spouse is in care, and then what's left over for the surviving spouse. I would say to people, listen, from a pure money manager RIA perspective, how much would you pay for an option that would protect the portfolio from ever experiencing a 10% downside return? And that you have in excess, you have a 67% chance for your clients over age 65 that they're looking at that downturn. How much would you pay for that option? Just from a pure RIA perspective. And again, in 10 years, that number approaches $700,000 a year. That's at 5% inflation. We all know how much healthcare is being inflated. 5% is probably a wishful thinking, at least based upon how healthcare costs are going today. So who pays? So there's a lot of people have misconceptions about who's going to pay. So someone said, well, I have long-term disability. What is long-term disability cover? It covers lost income, but it doesn't pay for any long-term care needs. And most disability policies today either terminate at age 65, age 67. There's some that are going out a little longer. You can buy extension riders, but they're going to stop at age 70, right? And when do most people have long-term care needs? After age 70. Typically after age 75 is when the probabilities start to grow. So long-term disability is not going to provide any type of relief financially for a long-term care need. Medicare. Medicare only covers the first 100 days after you're discharged from the hospital. First, you need to be in the hospital for 3 nights, over 3 nights. It doesn't have to be 36 hours. You have to be in there 3 consecutive nights, be discharged to a rehab facility or some other type of caregiving facility. And maybe you can be discharged to home and you need home health care. Medicare will cover 100% of the first 20 days, but there's a caveat. You need to be showing progress. If the person you're caring for is discharged and they're told they need to go to rehab and they go to rehab and they refuse any type of participating in any of the rehabilitation, after 10 days, Medicare will stop paying. They have to, that facility at the end of the first week has to start filing update progress reports with Medicare every week. So for the first 20 days, it's 100% covered. And then at the remaining 80 days, there is I think it's $187.50 a day deductible that you must pay for the next 80 days. On day 101, they're done. It is now 100% out-of-pocket costs for that person if they're in a rehab facility, if they need home health care, if they need to go into an assisted living facility because of whatever has transpired to get them to that point. Day 101, it's 100% out of pocket. Health insurance does not cover long-term care expenses. Medigap policies are health insurance and do not cover long-term care expenses. Medigap policies basically cover the same things that Medicare covers. Now, a Medigap policy, if you have a good one, they'll cover the $187.50 deductible for those 80 days, and therefore you have zero out of pocket if you have a good Medicare supplement. As far as Advantage plans, most of them will not cover 100% of that $187 deductible. So a good Med Sup will get you through the first 100 days, but then it's done too. Once Medicare's done, the Med Supplement stops paying as well. There's self-insurance. Well, that's what most people do, right? They're self-insuring, and it's not self-insuring, they're self-funding. We've got an interesting piece. One of our carrier vendors, Mutual of Omaha, our rep with the company wrote this fantastic piece about the distinction between self-insuring and self-funding. We have the piece available. We will be sending it out to everybody on the call today so that you can read it, because it really is a different perspective about there's no self-insuring, you're self-funding. But this is the biggest financial risk that most people facing long-term care costs. Again, you look at a $5 million portfolio, and all of a sudden you start draining out $200,000-300,000 more a year off that portfolio on top of the living requirements of the other spouse. It doesn't take much to tip that portfolio from growing to being depleted. And then there's family members. The family members they take you in, they take the person into their home. Why? Because they can't afford to pay for it elsewhere. And so then the family starts paying the costs of taking care of that person in their home, or helping them the person stay in their home, and they start paying the costs out of pocket. 53% of Americans who cared for a loved one lost income due to the demands of providing that care. I know, again, personal experience, and I know several people that I work with here at C.O.R.E have all had the same experience as me. It's nothing unique to me, but I know I missed quite a bit of work over the 2 years that I was taking care of my mom. Things come up. You got to, okay, drop everything and run. It happens for all of us. So what are the benefits of private long-term care insurance? One, it provides certainty in your planning and outcomes. If you buy a plan and you're like, okay, I know I got this pool of money, I've got this pool of resources that should something happen and I need it, it's there. It avoids physical and financial dependence on family and friends. Again, if you have long-term care, it will help bring in people to take care of you. One of the things, and I don't know how many of you have had this experience, but the whole time I was growing up, my mother was like, I don't ever want to be a burden on you. And the joke in the family is, what's your long-term care plan? And it was Smith and Wesson, right? And it was, tongue in cheek, obviously. But it helps take that burden that you don't want to be on your kids, and the long-term care takes care of it, both from a physical resource perspective and financial perspective. It protects hard-earned assets. Again, think of buying a long-term care policy as buying a put.
Back about
You can maintain choice on how and where you receive care. If you go into a Medicaid facility, which requires you to deplete all of your assets down to $2,000, you have to basically become destitute. Then you qualify for Medicaid. You don't get to pick which facility you go in. Medicaid's going to pick the facility you get to go in. They might give you 2 or 3 choices. But if you've ever been in a Medicaid facility versus, say, a Marriott facility, there's a great big difference between the quality of life and quality of care in those facilities. And it ensures a high quality of care at an affordable price, because one of the other benefits of owning long-term care, and it's undervalued as well, is not only do you have the financial resources and they can help you get care, but they have the resources to help find the care. They have the resources. John Hancock has a great program where they're like, here, this is who's in your area. They have a care coordinator that helps you. How do I get this process done? How do I get this set up? Who are the best providers in the area? And they provide you a pool of resources when you most need it, because I'm going to tell you, when you have to make that choice, you're making that choice in about a week or 2 time frame in a lot of instances, because some event happens that wasn't expected, and you now have to find these resources. Most of the long-term care providers that we work with have these care units that you can reach out to and say, help me. And they have all the resources, and I'll tell you, when my dad was trying to get long-term care for my stepmother, and he called John Hancock, I was absolutely floored. They would call him back over and over again, trying to find ways to help him with that, pull together solutions. It was incredible. It gives you more options to stay at home when you need care. Again, most people want to stay at home as long as they can, and it helps provide the resources to do so. It helps you maintain your independence. It maintains family harmony. Family harmony. Again, it's about the relationships, and one sibling is bearing 90% of the responsibility, taking care of their parent or parents, and it causes strain with the other siblings. But who's going to do what when? Who's going to participate? Who's going to help? It enables your family to supervise care instead of provide care. I will tell you that that's a great resource. You're managing the caregivers. You're not being the caregiver. And it transfers the risk and responsibility from you, your spouse, and your family to the insurance company. Sources of funds, again, Medicaid is probably the largest single provider of care in this country as far as long-term care. But that means 40% of the population goes destitute before the government comes in and helps. Then there's Medicare, it's 23%, but again, that's only the first 100 days. But if you look at private insurance, it's less than 10% is provided by private insurance. 22% is covered out of pocket. 3% is other private, meaning family, and then other public. Certain states have additional resources that on top of what Medicaid provides. So this is such a looming problem. So when the Affordable Care Act was initially being drafted, they tried to put a nationwide long-term care plan in place. And the actuaries couldn't make it work because what they would have needed, the tax increase to fund the Affordable Care Act with long-term care would have been unpalatable and probably wouldn't have passed. So they said, listen, let's do the best that we can. We got to table this long-term care conversation. Let's get the Affordable Care Act in place. And whatever you think about it or not, again, it was a political and economic decision to cut long-term care out of the bill because the cost would have been so great that the bill would have never passed to get the health insurance part done. So they dropped it. But the government has provided tremendous amount of tax incentives to provide long-term care solutions in the private sector. So from an individual W-2 wage earner, the premiums for long-term care count as a medical expense, and it's deductible to the extent that other medical expenses are deductible. So medical expenses in excess of 7.5% of AGI are deductible on your federal income tax return. Currently in 2025, that number has fluctuated between 10% and 7.5%, and over age 65, it's currently for 2025, the threshold is 7.5%. So the IRS publishes a table that says at these given ages, this is the amount of long-term care premium that you can deduct if it's in excess of your 7.5% medical expense. So self-employed 1099 wage earner. So if you're self-employed, 100% of the premium is deductible. There is no 10% threshold to meet as an independent, as well as for your spouse's premiums. Again, there's a table published by the IRS that says this is the amount that you can deduct. With C corporations, they have the most favorable tax treatment. A C corporation can provide long-term care benefits, pay premiums for long-term care insurance for their employees on a discriminatory basis and deduct 100% of the premiums, both for the employees and the business owners. So in a C Corp, it's a tremendous, if you're looking just from an executive compensation perspective, we usually talk about tax deferred growth, tax redistributions, overfunded cash value life insurance as a alert program for non-qualified executive comp. But hey, Mr. Executive, we're going to pay this premium for your long-term care and have a paid-up contract by the end of year 5 or year 10. And as long as you stay with the company, we'll keep paying the premiums, and you'll have this paid-up long-term care policy going into retirement, providing you a $600,000 pool of income tax-free long-term care benefits. That's very attractive, and it can be done on a discriminatory basis. Partnerships, LLC, and Subchapter S is for the owners. It's same as self-employed deductibility. I've never understood this, why they carved this particular class out, but basically it's the same as if you're a W-2 wage earner. But for employees, an S Corp or any type of pass-through entity can provide long-term care benefits on a discriminatory basis for any of their employees and deduct 100% of the long-term care cost of the premium, and the employee doesn't recognize it as income. And then lastly, this was passed in 2006 as part of the Pension Protection Act. So let's say you have an annuity policy. It's got a $100,000 cost basis and it's got a $300,000 value. You can roll that annuity into a long-term care qualified annuity, and you can now access those gains out of that policy income tax free if you're using it to pay for long-term care premiums or you're using it to pay for long-term care expenses. So you can get those annuities out. And, we have a handful of companies where they have products that qualify as that long-term care annuity. And you know what makes it qualify as a long-term care annuity? They put a line in the policy that says this is a qualifies as a long-term care annuity. I think personally they should allow make it a universal offering in all annuities retroactively so that you don't have, if you're in an annuity, you don't have to move it, right? Like what's the difference? So you move it over, oh, now I can get the money free, but there's absolutely nothing other than that line in the policy document that makes it that qualified plan. But if you've got clients with highly appreciated annuities, this is a great resource. If they're uninsurable and they can't get long-term care in any way, shape, or form because of pre-existing conditions, you still have this avenue to get tax-favored benefits out of highly appreciated non-qualified annuities. So let's talk about the various solutions. Let's talk about traditional long-term care insurance. When I got in the business a ways back, there were probably 30 companies offering traditional long-term care. Here at C.O.R.E, we have 3 left that provide long-term care. We have Mutual of Omaha, we have National Guardian Life, and we have Thrivent. Now, a lot of the big mutual companies like New York Life, Northwestern Mutual, they still offer long-term care, traditional long-term care policies. But again, the number of people out there providing it are few and far between. Genworth, which dominated the marketplace, has stopped issuing new business quite some time ago. There's rumors that they might get back into the retail space once they get their balance sheet straightened out. But traditional long-term care insurance, I equate it from a premium benefit perspective as car insurance. You pay this premium every year, and if you have an event, the long-term care policy pays. Should you die before you have a long-term care event, the premiums are gone, right? If you pay car insurance your whole life and then you die and you never filed a claim, they don't refund the premiums back to your family. So with traditional long-term care, it's if you don't use it, you lose it. But you can get spousal discounts up to 10 or 30%. You can have built-in inflation protection. Premiums may be deductible, again, based upon the various tax rules with regards to deductions of long-term care premiums. You have asset protections if you're using a partnership plan. Many states have partnership plans. And if you buy a partnership policy, and let's say you buy a $500,000 pool of long-term care benefits in a partnership plan, so typically for you to get state aid with long-term care, you have to spend your assets down to $2,000, right? If you buy a partnership plan for $500,000, the state will allow you to protect $500,000 in assets, and then you can apply and qualify for state aid once you've gone through that $500,000 pool of a partnership plan. It provides the most leverage for long-term care. It gets you the most bang for the premium dollar. And so if you're going to spend $3,000 a year in a traditional long-term care versus one of the other options we're going to discuss, typically you're going to get a better outcome. Although I will say a lot of the asset-based stuff, I can't say that with confidence without running the numbers on every case. So what are the cons? One, the premiums are required until filing claim or for the rest of your life. We no longer, well, National Guardian Life offers some short pay solutions, but we don't have a lot of short pay solutions anymore. They're typically life pay, possible rate increases. We should probably say probable rate increases. Over the last 10 years, most of the large long-term care issuers that, though they've stopped writing new business, they still have a large book. The premium increases have been anywhere from 10, 20 to 100 to 120% increases on the premium. And I will tell you, most of the time, if a client brings us their policy and they say, I just got notice that they're increasing my premium by 100%, what should I do? And our response typically is, can you afford it? Is it going to be a burden to pay the premium? And if they say no, it's pay the premium, because even at double the cost, the policy that you have, you can't get today. And it's a great policy, and you should keep paying the premiums. The only time we're going to make any recommendations about reducing benefits or capping benefits is if the new premium is a financial burden, where they're like, yeah, I got to make a decision between paying my rent and paying my long-term care. Different discussion. But if we have semi-affluent and affluent clients and their premium goes from 3,000 to 6,000 a year and it's not making a dent in their lifestyle, pay the premium. Because again, most of those contracts can't be replaced at any cost today. So most long-term care policies tend to be reimbursement only as well. Some of them might have a rider where they'll give you some type of a cash indemnity benefit, but on a reduced basis. But typically all traditional long-term care are reimbursement only, which means you have to incur the expense, and at the end of the month, you turn all your receipts in, you file for reimbursement, and then the insurance company will take anywhere from 10 days to 21 days, and they'll send your reimbursement deposited back in your account. So you're paying forward, file for reimbursement, and they scrutinize every receipt to disqualify for those benefits. So traditional long-term care, still viable, certainly should be looked at in every case. And that's something that we do is if you bring us a client and say, hey, we're looking for this pool of benefits or this monthly benefit, we're going to look at both traditional and asset-based, show them side by side and say, here are the two options, and help the client and help your client make an informed decision about which choice they should make. Asset-based long-term care strategies. This is what I would say that 85% of our long-term care solutions are in asset-based long-term care strategies. So when I talk about asset-based, I'm talking about Lincoln MoneyGuard, Nationwide Care Matters, Secure Care. One America has a portfolio of solutions, asset care and annuity care solutions available. New York Life just came to the marketplace with a decent program. So we have the universe of asset-based solutions, and it's going to be really, and we run every one of them every time if you come to us and say, hey, we're trying to find a solution for our clients. So what are the pros? One, guaranteed benefits. So what you see is what you get from day one. We have one product from Lincoln that has a market-based feature to it. We typically will show that for younger people that are, say, in their 40s or early 50s, because it's got some upside potential based on market performance. But generally speaking, what you buy on day one is what you get. You're going to buy this pool of benefits. You're going to put this inflation rider on it. It's going to be for this many years. That benefit's going to work. And we know if you live 25 years, this is what your benefit will be 25 years from now. And the premiums are guaranteed. The premiums can't go up. It's okay if you do it because you could do a single premium, you could do a 5-pay, a 10-pay, you could do a pay to 65, you can even do a life pay. But one of the features is that these products, the premiums don't go up. If you don't use it, you don't lose it. These are life insurance based arrangements, which means the underlying policy is a life insurance policy with a whole lot of long-term care rider tacked on it. Most of these asset-based solutions, you'll see that the death benefit really isn't much higher than the premium put into it, depending on the age of the insured. But the pool of long-term care benefits is a multiple of the premium paid and the face amount of the policy. But if you never use it, your family's at least going to get a refund of the premium via the death benefit, right? I mean, if you don't lose it, here it is. It's not going to get some great rate of return, though. Again, we've got some products that are getting into that space where there's a potential upside. You can have a one and done or a flexible premium payment schedule. You can pay with cash or can transfer existing cash value of life insurance to fund the strategy. One of the things we see a lot is people who, I've got a $500,000 whole life policy at XYZ company, and I got $300,000 of cash value. So really your client has $300,000 of cash and $200,000 of insurance. Typically we can, if they're, a standard risk, we could take that $300,000, provide a $325,000 death benefit, and provide them with a $800,000 pool of long-term care benefits. So yes, you've given up some death benefit, and it's not always. Sometimes we can match the death benefit plus turn it into a giant pool of long-term care, a multiple, two, three, four time multiple of the cash value into a pool of long-term care benefits via 1035 exchange. We have an expedited approval process. Most of these have knockout questions. There's 5, 6 questions. If the client can answer no to all the questions, typically you can get policies issued in a 7 to 10 business day cycle. A lot of the carriers, when this first came, oh, we'll get it issued in 72 hours. You can get underwriting approval almost instantaneously, but then the mechanics and the logistics at the carriers of actually getting the policy processed and issued, we like to say 7 to 10 business days, um, under promise and over deliver. And you can choose between reimbursement or indemnity. So some of the products that we have offer reimbursement, and some of them offer indemnity. Now, pretty much both sides of that equation, they're both coming in and offering a hybrid of where you can choose between indemnity and reimbursement. And now in many of the products, you don't even have to choose until you want to go on claim which one you want. And here's what the benefits look on this pool and this pool. So there's a lot of flexibility there. I will say that some of the best innovations in the insurance marketplace over the last 20 years have been in the long-term care, asset-based long-term care. The benefits and features that they keep coming out with for the consumer are fantastic. The products just keep getting better and better. Yes, sometimes there's pullback on pricing. The pricing waxes and wanes, but the overall portfolio of solutions that they're providing today is the best that it's been in the business for some time, the flexibility and the choices. So what are the cons? The best leverage is a lump sum investment. It's not required, but you could have it where the client writes a check, they set it and forget it. They've got a $300,000 pool of treasuries or CDs at the bank, and that's their rainy day funds. You take 100,000 of it, put it into a single pay. Now, some of these products can offer from day one 100% surrender value from day one, but many of the solutions we show an 80% guaranteed surrender value from day one, and for the life of the contract, it's going to get you a larger pool of benefits. Say, hey, worst case scenario, you want your money back, you get a mulligan, you can request your money back. Again, you can design it where the 100% refund, 80%, 75%. Obviously, the bigger the surrender value guarantee, it'll reduce the pool of benefits that's available. But typically, it requires a $50,000 or more single premium. And once we get over age 70, and I would say we're pushing that out to 72, 73 as the products evolve, there's not a lot of leverage, right? It's, you're not getting a lot of leverage out of the program. So it has to be really under age 70 is ideal. And people say, well, how young should they start considering it? I'd start talking to my clients that have the means after age 40. Because you can get a substantial amount of leverage at age 40 for a very little premium. If the client has the means to do it, the sooner they do it, the better. But those are the pros and cons of asset-based. Again, this is where the majority of our solutions are coming in on the long-term care spectrum. Then you have accelerated benefit riders. So your client has a need for life insurance, whether it's for maximizing their estate, providing more for those they care about when they pass, or they need it to cover liabilities, or they're using it as a supplemental retirement program and they're trying to maximize accumulation and tax-free income in retirement. You can add a long-term care rider to that policy. So how does it work? So let's say a client's buying a $1 million policy and they put on a 4% long-term care rider. That means they can get $40,000 a month out of that policy for long-term care needs. Now, so one, you have guaranteed benefits, 2, guaranteed rates. Monthly long-term care benefit can be the largest of all the options. Again, if you have $1 million, and typically your options are 2, 3, 4% monthly distribution off that policy for long-term care benefits. Plus, it's got the largest death benefit. If you don't use it, you don't lose it. And the part you don't lose is the biggest pool of funds that can be passed to your heirs, because that death benefit, again, we're going for death benefit first, and we're adding the long-term care rider as an adjunct benefit to the plan. You've got flexibility of funding because it's traditional life insurance. There's all kinds of funding scenarios we can put in place. We can have guaranteed scenarios. We can have current assumption scenarios. There's all kinds of funding flexibility. You can pay with cash or, again, transfer existing cash values from another life policy. And some do provide an indemnity benefit with the riders. Almost all of the major carriers that we work with have some type of a long-term care rider or what they call an accelerated benefit rider or a critical illness rider. There's nuances between them, between whether it's a 101 rider or 7702 rider. The interesting, but those distributions come off as accelerated death benefit or income tax free. The IRS issued specific rulings that you're just accelerating the death benefit, and because it's a death benefit, those benefits pay out income tax free. So what are the cons? The surrender values could be less than premiums paid. Typically, they are, at least in the initial 10 years of the program. The surrender charges eventually will go away. And it's a fixed benefit pool. I'm not aware of any on traditional life insurance riders that have an inflation benefit built into them. I think we have one carrier where if we do an increasing face, they'll allow the long-term care benefit on the entire face amount, including the increase. But most of the carriers, even on an increasing face, will only put the inflation rider on the base original death benefit. But so there's not inflation. But if you're typically when we're starting out today, we're looking at between $3,000, $5,000, maybe $6,000 a month in benefit and putting a 3% inflation rider on it and going out 20 years, right? So what are you going to get to? So you're going to get to, $11,000, $12,000, $13,000 benefit in your 80s. Well, if I'm buying $1 million policy and I'm putting a 2% benefit rider on it, I have $20,000 a month for 50 months. And I don't have to draw it all down at once. So it kind of has an inflation. I mean, assuming we don't hit hyperinflation, the initial death benefit out of the gate is going to be greater probably than a 3% inflation rider benefit on an asset-based long-term care going out 20 years. So pros and cons of accelerated benefit riders. And again, and I did need to mention the asset-based annuities. So we do have asset-based annuities. There's a spectrum of those annuities. Some will let you 1035 the money in, and they'll give you a multiple, a 2 or 3 or 4 time multiple of the deposit as a pool of benefits that are available. But worst case scenario, you get into a long-term care. There's no leverage, there's no nothing, but it allows you to take the gains out of the contract income tax free to pay for long-term care premiums or long-term care expenses. So there are annuity options as well, and they're expanding. Nationwide just came out with a great product where the cash value actually grows. Most of these long-term care annuities, some of them will have riders that can actually start spending down the value of the annuity because the rider charge, if you're doing a 4 times leveraged pool of benefits, they might be charging a 1 or 1.5% annual fee on the cash value of the policy. And if it's only earning 2, 3, 4%, the cash value slowly will deplete, but it's not going to deplete, before age 100. And the pool of benefits is always there. But some, with the new Nationwide, you actually can see your cash value grow in this product. And even in this interest rate environment, it's showing positive growth on the annuity plus a pool of benefits. So as I said, the products keep innovating and keep getting better for the consumer. So things to consider, daily or monthly benefits. I prefer monthly versus any type of daily benefit. So in any given day, if you have a $250 daily benefit, and one day your costs are $125 and the next day they're $500. Well, you're going to be out of pocket $250 on the $500 day, and you're not going to get to carry the other $125 over. The pool will still be there, but you can't get it out any faster than $250 a day. I'd rather have a $3,000 a month or a $4,500 a month benefit, so that it's an average cost throughout the month. As long as your cumulative costs don't exceed that monthly benefit, you can have lumpy expenses throughout the course of the month. What benefit cap do you want? What elimination period? Typical elimination that we're seeing is 90-day, but a lot of the products are coming out with 0-day elimination for home health care and other services. Some are dropping it down to 60. What inflation do you want? So typically what we see, everyone, oh, I'd love to have a 5% inflation. So with the asset-based stuff, the irony of that is that if you start off with 5% inflation, because it's the most costly option, you're going to start off with a lower benefit today, and it'll inflate at 5%, say, for the next 20 years. What we're finding is that with a lot of the products, if we start off with a 3% inflation, the initial long-term care benefit is much higher today and is actually higher 20 years from now because you have a larger base growing at 3% versus a smaller base at 5%. But there's 3% inflation, there's no inflation, there's all kinds of different ways to structure the inflation. Our default is 3% because of that sweet spot that, okay, yeah, you start off with 5%, but in 20 years when you need the benefit, you're going to have a bigger pool had you started off with a higher benefit at 3% inflation. You can have shared benefits. Do you want to have a pool where both spouses can access it? And if each spouse has their pool and the one spouse doesn't use their pool, can the other spouse put it on top of theirs? What payment options do you want? What, single premium, 10 pay, life pay? Potential changes to ongoing premium. Do you want the uncertainty of a traditional long-term care policy and the fact, and again, it's probable the premiums are going to go up, not possible. Do you want non-forfeiture provisions, which means that worst case scenario, if you buy a traditional long-term care policy and you pay premiums for 10 years and then you stop paying, at least you'll have a pool of benefits equal to the 10 years of premiums that you paid into it. Do you want any exclusions? Do you want indemnity or do you want reimbursement? Do you want a chronic illness rider? Do you want a chronic illness rider to have a temporary clause where you can access the funds on a temporary chronic illness thing? Say you're incapacitated for a year recovering from a major accident. Can you access it? Or does it have to have a permanent disability for you to be able to qualify for those? All questions that we can help navigate when you're looking for solutions for your client. So what works best for you? It's too important of an issue to be left to chance. It warrants a conversation with our clients about the options, about the risks, about the costs of what they're facing. And again, 67%, and the statistics now, 70% of the population over the age of 65 is going to need some type of long-term care coverage that is not going to be paid for by Medicare, Medicaid, or any other source. We're full service financial professional, can help determine which strategy is best for you. That's a line that you can provide to your clients. Can't make the decision in a vacuum. It needs to be coordinated with your overall financial plan. You have questions, we can help. We've been doing this for some time. We've got a lot of experience in this marketplace. Please lean on us as a resource to help answer your questions, your clients' questions, and help optimize the client's outcome for their reasons. Whatever it is they're trying to accomplish, let's optimize that outcome for them. So schedule a call with your relationship manager, see how, what opportunities you may have with your existing clients. I mean, that's where I would start. If you've not had this conversation with every one of your existing clients, and they're in the semi-affluent and affluent marketplace, I'm going to tell you, even in the ultra high net worth space, they didn't get ultra high net by being bad with money, right? I mean, so if you're worth $100 million, could you self-insure? You could, but why would you? I mean, I think people worth $100 million are still buying insurance on their $20 million estates, right? That's a big burden. If I'm going to go into a long-term care facility and I'm worth $100 million, I'm going into a 5-star freaking, $10,000 a day facility. I got private nurses and all gourmet chefs and all that stuff. The costs are relative. If you can insure a portion of it for pennies on the dollar, why wouldn't you? So again, and we're going to send out this piece about self-insure versus self-funding. So, but in the semi-affluent and affluent marketplace where their net worth is, $500,000 to $10 million, they should be considering these solutions. And you should be talking to all your clients. We bring it up in $100 million cases. You ought to take a look at this. Hey, there's tax leverage. Hey, you got a C corporation. You're making all this money. Why don't you take some benefits off the table, income tax free, and buy yourself this solution? We can assist you to make a confident and informed decision that optimizes your outcomes for your reason. This presentation is also available if you would like us to provide it to you so that you can use it with your clients. We're happy to provide it to you. You'll need to get it approved through your broker dealer, obviously, but most broker dealers, because it's dealing with long-term care and isn't associated with securities, they'll just give it an approval with no change. But I would ask that you run it through your broker dealer's advertising department. So that's our presentation. I am, quite frankly, new to the Q&A here, so let me pull up the Q&A. Are we going to share this with presentation? Yes, we will send this. Actually, the presentation, if you'll send us an email requesting it, we'll send it. We don't want, it's a 13 megabytes, so it's a big file, so we don't want to clog up people's email if they don't want the presentation. If you'd like it, either reach out to your relationship manager or send us an email, and we were happy to share the presentation. Again, we're going to send out a thank you follow-up with the piece that we have on self-funding versus self-insurance. I don't see that there's any other questions. I'm trying to see if I can unmute everybody in mass. I think you can, if you have a question, you can unmute your microphone and ask the question. I was seeing if I could turn it off in mass, and I'm sure there's a way, but by the time I find it, it could be 2 o'clock. So I appreciate everyone taking time out of your busy days to join us. We're C.O.R.E Group. We provide risk management solutions to financial advisors, life insurance, annuities, long-term care, disability income. Please give us a call if we can be of assistance with you and your clients. Thank you and have a great day.